Stock prices are not randomly generated values. Instead, they can be treated as discrete time series model which is based on a well-defined numerical data items collected at successive points at regular intervals of time. Thus, time series analysis can indeed be useful to predict stock trends. Understanding this, we have come up with this tutorial on time series in stock market. Now, before we guys head off to the session, I'd like to inform that we have launched a completely free platform called as Great Learning Academy, where you have access to free courses such as AI, cloud, and digital marketing. You can check out the details in the description below.
With this, I would like you to walk you through this today's session objective. We would be having a brief overview of the capital market, what this is all about. Second, we will also look at certain kinds of forecasting methods like the exponential smoothing and the ARIMA. After this, we will also be looking at some kinds of an accuracy measures for all these models that we have developed. And then let's question this: are they really good enough? Do they really work? Do they require any kinds of fine tuning or not? So friends, what exactly comes to your mind when I speak about the markets? Something like a place where something is sold and purchased in exchange of the currency, isn't it? Well, if I correlate this to our financial market, we are referring to the capital markets. So when I say capital markets, they are well organized and they are organized into two segments. One is the primary market and the second one is the secondary market. Primary market is basically a place where the new securities are issued to the investors. The investors are nothing but they are the companies who wants to raise the capital as they have certain kinds of expansion plans and growth. Secondary market is a place where I can say it as a follow-up to the primary market, where you have all these instruments like stocks, bonds, options, futures. They are all traded. When I say traded, they are bought and sold in this market. Now, all these transactions which happen, they needs to happen at one common platform. These platforms are called as an exchange. In India, we have two major exchange, I should say. There is the first major exchange is BSE, Bombay Stock Exchange, and the second one is the National Stock Exchange, NSE. There are other exchanges which also deals with the commodities and all. But if you see these exchanges, they have more than 2,000 stocks with them. And however, now if I want to know how my markets are performing, I need to have some check. I need to have some kind of an indicator, right? So these indicators, I can say it as an index. The index is what measures the strength and performance of these markets. If I get back to the major indices in India, they are Sensex, which is called as a sensitive index, and Nifty, Nifty 50. So Nifty 50, why do they say Nifty 50 is? It is a combination of 50 stocks, and Sensex is around 30 stocks, which forms the part of this index. When I compare this to the world indices, which we will be looking at today, there are several such world indices like Dow Jones, which is of America, Nikkei of Japan, Hang Seng of Hong Kong, DAX of Germany. Out of this, we'll be looking at three of the indices today. So with this basic information, I like to share certain very interesting story with all of you. This story is all of an investment decision which was made by my friend. So please tighten your seat belts. There are certain interesting things which are now going to come in here. On your screens, you see this. This is a Nifty 50 daily chart. I have taken this from way back in 2018, February 2018. Now, this is the story of my friend who was very, very passionate about this stock investing. In the early 2016, he started investing good lump sum of money. He kept investing. His mantra was very simple: buy on dips. Moment the market is down, buy it. So he was following this mantra for a long, long time. You know what happened? His confidence started peaking up. Come in this January 2020. Come in this January 2020, and he saw that the markets were making higher highs, higher highs. Then came in this January 19 when the market started falling. It was a fall like a falling knife. The moment you try to catch, you will bleed. That is what happened here. Next, I have shown this with one vertical line. This is relates to around 20th of March. If you guys remember, 24th of March was a day when a lockdown was announced in India, right? Now, what is the thing that comes to your mind when it's lockdown? Entire economy is down, country comes to a standstill. What will happen to the markets? Nothing but it will be a case of just sell. That is what happened here. My friend thought that now this is the point where it will start sliding here. Moment he saw this, the moment he heard this, next day morning he started selling what was there in his portfolio. He cleared up his portfolio completely zero with loss. See the fun what happened. Post 24th of March, the markets started increasing. Right? This was the time when he started scratching his head, pulling his ears in despair. He was not able to believe what was happening. Nothing worked out, frustrated, seeing this is out of his range. Friends, why did I narrate this story to you is around 95% of the people who are trading and investing in the stock market have a same kind of an story. This moral of the entire story which I narrated to you is, if you want to be a good investor or a trader, you have to be first disciplined here. Every one of us need to have a good strategy in place. Also, we have need to have some good understanding of this markets. We should have some good methods that can work out in this field of stock markets. Stock markets are fluctuating like anything, and I will show you this in my coming slides. So let's to in today's session, let's explore what really works, what really doesn't work, and what is that we need to fine tune so that it works in the stock markets. I'm not claiming any method will be the best method, but this is a first step towards forecasting. So with this basics, let's explore the following markets. These are the world indices which I am showing you here. On my left, this is the Dow Jones of America, and on my right, it is Nifty 50, which is Indian market. See here, isn't it a mirror image? Do you see this is a replica of each other? Look at this. This was 2008, which I mentioned to you, the subprime crisis, 2008 to 2009. The fall was so steep, deep, and it did take some time. But look at the same fall here from 2008 to 2009 in the Nifty, right? Same fall. Then now let's look at this, the crash which we have seen here in the months of February and March, exactly like a knife falling down. Same way the Indian markets behaved here. Look at this, the way it fell here. Okay, so let's look at the other indices. Okay, I have taken this of Nikkei. Nikkei is of Japan, and look at this. This is of Hong Kong, Hang Seng. Now, if you look at this, you would see that uh, see this is 2020 and this is somewhere around 2007. So if I take back here 13 years back, okay, I would see that I'm at this almost at the same place in 2020. Look at the Hang Seng again. It was somewhere around 20,000 points here. It is just about 20,000 points, but very close to it. Even after 13 years, they are at the same place. So don't you think India is a good place to invest? Can we get into the Indian markets? Now, with this thought, I thought, no, let me explore the Indian market, that is the Nifty 50. Looking at this, if I draw a straight line, I can easily see that it has some kind of a trending movement. If I would have invested somewhere here post 2008, somewhere I think I can take it as 2009, it would show me that yes, it has a good amount of trend. It is increasing, and certainly my money would uh, compound if I get into this. So let's analyze this from our data science per se. What we can do, how we can look at this is what I have showcased you in the next slide. This is it. Applying my data science techniques of forecasting, we have two techniques. One is the decomposition, and the other one is the ARIMA. So in decomposition, what I did here is I applied a STL method. I applied a STL method on it, and I started seeing decomposing this. I wanted to see what are the components. I wanted to see what are the components in this Nifty 50. What I could see here is there are trends. The Nifty 50 chart has trends, the seasonality, and the reminder. Now, the point here is if I um, take trend plus add it to the seasonality and add it to the reminder, I should get my original data here. Now there is something interesting coming out of this chart, and that is the reason why I thought let me show you this decomposition output. Look at this. 2020 is sharp, right? A sharp line here, a big line here. Look at the others. Okay, the residuals are not showing it. Now what happened is when we decompose this, when we decompose this, what it is saying to me here is this is an extraordinary movement which I cannot forecast. The Now if I look at this data science, and when I look at the time series especially, which we'll be using this for forecasting, there is a basic assumption that we all go ahead with. The basic assumption here is that what has happened in the past can only be reflected in the near future. This is what the time series says. What has not happened cannot be forecasted. And if I know what has happened in the past, then I will know what will be in the present. If I know what is there in the present, then I will be able to forecast what will happen in the future. This is what exactly happened here. The big fall was not able to digest, and it said, I can't see this as a seasonal pattern. I can't see this as a trend pattern, and hence I am throwing this out as a reminder. Isn't it interesting? Let's explore more and more. Let's look at this. This is the decomposition output. We got this. We will also go through the R code. I will make you, walk you through this R code where we have all these outputs. Look at this. The one which I have marked this in the red. I have marked this because there was a financial crisis which happened. Somewhere it started somewhere in the month of, if I remember it rightly, it was June, July 2008, and steeply it started falling across, and it continued till April 2009. I wanted to compare this with March 2020. Look at this. It says there are 2234 points that it couldn't capture, and neither as a seasonal nor as a trend. If I remember it rightly, there was a sharp fall of around 4200 points, and somewhere down the line, what it did is it picked up some of these values here. If I look at this, the maximum value was somewhere around 768. It was able to only digest this because this is what it saw in the past and try to extrapolate it in the future, but nothing, because the fall was around 4200 points. That is why it was not able to recognize this, and it said this is something random behavior which has happened. Look at the other things. January 2008, the seasonal component, 3.17. When I compare this to January 2009, that is what it says, 3.17. When I compare it to January 2020, the seasonal component remains the same, 3.17. This is how it starts calculating and forecasting. Let's move on to the other method. So the first method which I am going to take for forecasting is the the exponential smoothing. In exponential smoothing, we will now be looking at a simple exponential moving method. The reason this is what was taken is Wanted to explore this, whether this really works, if it works to what extent, if it doesn't work to what extent, and what is that we need to do if it doesn't work. Okay, so before we get into that, let me just give you a basic idea of how simple exponential smoothings are developed. The idea here is, what is the forecast? If I am trying to forecast for tomorrow, I have to know what is my forecast today. Plus, I should also know how wrong I was today in my forecasting. Now, if I translate this, my English, into algebraic equation, this is what it comes out to be. Y hat t plus 1, which is nothing but what I am forecasting for tomorrow, will be a combination of what is my actuals today plus what is my forecasted value today. But before I get further, let me just give you a brief here that whenever you're doing any data analytics here, any data comes out with certain kind of a noise. The noise has to be either eliminated or reduced. This is where this component is helping me out to dampen. I can better explain this by an analogy. During this a classic case of a lockdown period, you know uh, we can correlate this to the lockdown period. We are all working from home here, and there is a lot of noise, isn't it? Noises from our kitchen, noise from the children's around, and etc. Now what will happen? You will not be able to work, the productivity will go down, and what will you do for this? You will take an action, right? All of us will take an action to cancel this noise, either to dampen it or to reduce that noise. The actions that we all of us will take is isolate ourselves from getting into one particular closed room or putting on headphones. This is exactly what this alpha is doing here. It tries to adjust that errors which are coming out of it, and it tries to smoothen that out. The alpha value here moves within the range of 0 to 1. I'll not go deep into how this we have come across this algebraic equation, but it is an interesting point to note here. If I replace this alpha by 1 by 2, okay, if I replace this alpha by 1 by 2, it comes out to be 1 by 2. This coefficient comes out to be 1 by 2 into 1 by 2, that is 1 by 4. The third coefficient comes out to be 1 by 2 into 1 by 4, that is 1 by 8. So if you look at this, the coefficients are 1 by 2, 1 by 4, and 1 by 8. What do you see? The weights which I am giving to this coefficients, this past observations, is decreasing as and when I get into the past. They are decreasing exponentially and then forecasting it. Hence, this model, this method is called as exponential smoothing. It is exponentially smoothing the noise that is being caused by the data that we have taken here. Okay. So with this brief overview, I will walk you through certain, the R codes, which will talk to you about what are the analysis that were done on the Nifty 50. For the sake of simplicity, I uh, took two files so that the files do not get overburdened, and we can follow this very easily. So look at this, the Nifty 50. The libraries which I have taken here, these are the very common libraries which we require: the forecast, smooth, graphics, data sets, T series, and ggplots. Ggplots is for the graphics that we are going to see here. FPP2, the impute TS. Okay, now this impute TS and the XTS, you can ignore this for the time being. The impute TS, if we use it if there are certain kinds of data which are missing in my data series. Okay, so fortunately the data which I have for the Nifty 50 is complete in full sense. There are no missing data there, so we can ignore this. And this XTS is the library which we use if we have data in the Excel format. Okay, I have taken it in the CSV format here. So let me just run this. Now, these are the indices. These are all the world indices that we have. I have stored it in their respective variables. These are all the data has been stored in the CSV file. Each of the world indices are in different CSV files. I'll run this. Okay, what it says is I've just looked the data for the Nifty 50. What it says is there are 151 observations and 9 columns. In this 9 columns, I'm not going to work on all the 9 columns. I'm going to take only one data, one feature. One feature is the closing. So you will see all the closing prices here. The time series that I'm going to take is for the closing price of Nifty. Okay. Now the data which I have is in the raw format. I have to convert this into my time series object. So we have a time series function which takes the raw data Nifty 50 and I put it there on my fifth column, which is my closing price. I start with uh, the data. My data starts from September 2007, and that is the reason why I give it a start here, so that my data series understands where I need to start. Okay, assuming that it has a frequency, I give a frequency of 12 here, and let's see how the plot looks like. Okay, so all the plots which has been designed which have been used here is using the ggplots. The ggplots are fantastic to look at. It gives some kinds of scales here, and it is very easy to recognize, and that's the reason why the ggplots are being used. Fine. Now we have already seen this chart. We also discussed about it, that it has a trend component and trend, seasonality, and the reminder. Let's move on. This is the plots which we have already seen for the world indices. We'll just run it off. The same techniques that we use here. We use a time series function to create it as a time series object and plot it here. Well, we have seen all these indices. Okay, fantastic. I wanted to see what the start of this data is. I wanted to see what the data, the end of this data is, and then a frequency. Let me run this. Also, I wanted to build a regression a line. I wanted to see how the trends are. This will be useful even during our ARIMA, and that's the reason why it has been plotted. So looking at this data, what it has come is, what it says means is it starts from September 2007 and the end of the data is 2020. Okay, I would have even taken April, but I've just limited it to March. Okay, now analyzing this time series, this is something very interesting to analyze, and we will spend some time on this. Here I am plotting a monthly plot for my Nifty 50. I'm looking at what the frequency is and what is the maximum observation of this. And I am also going to see at what is the seasonal plot looks like. This is something interesting to explore. Let's look at this. I'll run. Okay. Yeah, good. Look at this. Now, the moment you see at this monthly Nifty chart, you would be wondering the means are the same, right? It doesn't move at all, right? Second is the maximum values for January, February, March, April. It doesn't. It's almost same here. Why so? Now we have seen many of the examples that were taken in the class. For example, the GDP India. If I remember it right, is GDP India, the tractor sales. What did you see there? From January to February, March, April, it used to increase. Come June, July, it used to get stabilized here, and then we used to see from August, September, October, November, it is decreasing here. There was some kind of seasonality. Why it is not happening here in Nifty? Why don't I see that in here in Nifty? Right? That is the question that might be coming into your mind. So friends, Nifty is a combination of 50 stocks. When I say 50 stocks, they are picked up from several sectors. When I say sectors, they are coming from pharmaceutical sector, they're coming from sector, they're coming from IT sector, then oil and natural gas sector, the consumption sectors, auto sectors, all these sectors combined, some of the stocks from these sectors are combined to form a Nifty index. Now imagine every sector has its own seasonality. If I look at auto, most of the sales happens in the month of November, December, January, and somewhere in between whenever there are festive seasons. Take an example of Titan. Titan is mainly into jewelries and watches, right? Today is Akshay Tritiya, right? Now this is where if I look at the Titan stocks, you will see in the next quarter you will see it's rising. The stock values are rising. Come November, December, where you have Diwali, the festive seasons coming there, you will see the Titan chart. When you look at the Titan charts, it will show an increasing trend. That is a seasonality. Now, if I come down to the other stocks, from the consumption industry, consumption is always increasing here and there. When if I look at the other stocks, so they will have the other different kinds of seasonality. Now when I mix all this seasonality together, can I get a regular, can I predict something, some seasonality of it? No, right? There will be a bit here and there will be a small seasonality, but the seasonality will not be visible. That is what is happening here. Okay, let's look at the seasonality plots. Exactly what I spoke about. The seasonalities are uh, there are seasonalities, but they are not very much identifiable if I compare this to the stocks of Hindustan Unilever, Maruti, or Titans of that say. Okay, fantastic. Now, moving on, let's see what the decomposition talks to me about. If I sorry, when I use this STL function, okay, I think we have seen this. There are three components as what we have analyzed. I'll just run this code. Okay, I've used both the techniques, additive method as well as the multiplicative method. Look at this. We have seen this, the decomposition. What it says is this Nifty 50 has trend, seasonality, and the reminder. Moving ahead, these are the values which I have spoken to you in my earlier slides about how the total values are being formed. Okay, if I add up my seasonality plus trend plus reminder, it should give me the actual values for 2007. Moving ahead is the single exponential smoothing. Here comes certain interesting points. Okay, so before I show you this chart and how why it has been designed this way, I just want to put up a caution. The caution here is we should not forecast for more than 2 or 3 periods. The reason is these are stock markets. Stock markets are subjected to lots and lots of fluctuations. The one which we saw in the March 2020. Okay, so if you are trying to forecast for, say, even more than 6 months, more than six time periods into the future, it is not going to give you the right data which is being expected, right? So we will be only forecasting for only 2 or 3 periods. Now you might be saying, the why are we taking the 24? I just wanted to give you a comfort, because this is how we do it in our class. We always take either, most of the examples that we have come across is a 24, so I've just kept it to 24 here. And also I wanted to see how much it deviates. So let's run this. We have SES, that is simple exponential smoothing, which we apply on the Nifty 50. This is my time series. I plot the output, and I also see what the summary tells to me about. Okay, this is it. If you see here, something's very strange, right? It shows me a straight line, and there's no common sense, no common sense here, right? So I'll talk more about this when we get into the triple exponential smoothing, because all these concepts will be very clear there. But in a way, what we can see here is why it has given a straight line is the very first question. Second is, what is my confidence interval that is suggesting to me what will be my forecasted values. Third is, why has it started from this particular point? Why has it not started here, or why has it not started this point? Okay, so now look at this. This simple exponential smoothing method doesn't take any trend nor the seasonality. It says I don't recognize what is a seasonality in Nifty 50. I don't recognize what is the trend of the Nifty 50. That is one. Second, it says I know only where I can start from. That is what we indicate by something called as a level. So this is the level which I am talking about. It says my initial state. Okay, what does it mean? Initial state 5021. So let's look at this chart. It says I know where I need to start. This is the value 5021. It says I know where I need to start from, and then it starts estimating by taking 1 point estimate, and that is how it starts building up its levels. It starts building up its level. It takes the one past observation, and then it forecasts. This is how it comes to this point. It sees this level, it estimates, and it says this is the point where I need to forecast. And that is the reason why it starts drawing a straight line. Let's look at the other component. I think I told you about the alpha. Alpha is a constant which tries to dampen the noise. What is alpha telling me about? Look at this alpha. Alpha is 0.9999. Isn't it very close to 1? Why is it taking 0.999? Why it is not taking 0.0001, or why is it not taking 0.05? Right? So what it is saying is this method is telling me that I see a very sharp fall. Okay, I see a very sharp fall here, and I need to take care of this sharp fall. In order to take care of a sharp fall, I need to take a very high value of alpha. When I take very high value of alpha means I am going to take the very first observation in the past. So what is my very first observation in the past? This is that value, and hence it takes up 0.99999, almost close to 1. It becomes more clearer when we see this in our triple exponential methods. So I'll move on. Let's look at this double exponential. In double exponential smoothing, we take care of the trend. Okay, now I know what the level is. I need to take care of the trend because my Nifty 50 displays a trend with it. To take care of that trend, we include one more constant called as a beta here. Now you did not remember this alpha, beta and all, but it's an interesting point which comes out of all this analysis. We already have the method hold which does it for us, automatically brings up what should be my alpha and beta. You even need not do it manually, right? So let's run this, and we create an auto plot of it by using our GG method, and we also come out with a summary of. Okay, let's look at this. Please do not worry about this diff function. This we will be talking about this in our auto ARIMA when we go for an ARIMA for forecasting. Okay, look at this. Better than the simple exponential smoothing. Now what it does is it doesn't draw a straight horizontal line, but it draws a straight line with certain kind of a slope. It is telling me, okay, I recognize some kind of a trend. Okay, I recognize that kind of a trend, but I will not be able to but my slope will be very small. The reason being I see a very high dip here coming out of it. Okay, so look at this. Let's look at this alpha and beta values here. This is what it is. In the exponential smoothing, simple exponential smoothing, we saw it was 0.9999. Now it is 0.96. Okay, and beta, it is almost equal to 0.0001. Now what it says is this is the slope with which I am going to forecast. This is the slope with which I am going to move ahead in the near future. This is what it says. So hence, instead of the horizontal line, it has showed me a straight line with certain kind of a slope here. But is it the right method? Is it predicting the right values is the question? Obviously not. If I show you the Nifty 50 where it is currently, it is in 9,000. If I remember it, it is somewhere around 9,900 levels. Okay, the point estimate do not match with it. But the positive point which comes out of this is, if you look at the confidence interval, this is the 80% confidence interval. Okay, this one is the 95% confidence interval. My forecasted values lie between somewhere between this 80% confidence interval. If I look at the Nifty 50 where it is currently for the month of April, okay, it is closely, as I said, it is closely around 9,900 levels. Fine. So it is closely somewhere here. Look at this cursor, somewhere here. So it falls within my 80% confidence interval. But I want to again put up a caution here. We are in the markets, the stock markets. We are not forecasting any GDPs. We are forecasting the price of the stock market. When you are uh, forecasting the price of the stock market, it means you're putting down your hard-earned money there. Can we go with this forecast? Absolutely not. Okay, this needs some good amount of fine-tuning activities to be done. Okay, let's see. Now we'll go to the um, the triple exponential. But yeah, before we go that, there was some other explorations which was done here. Because of this sharp spike, what I thought is, let me take this of till December 2019. Let me take a data. I'll reduce my data to December 2019 and run and see what happens. Is it able to predict? What does it predict? Okay, let's see. Run this. Is the same. We use the hold method here with my start date and the end date. Now the end date is December 2019. Okay, let's plot this and see. That's fine. So what it says is, if there was no corona kind of a thing, okay, if there was no corona kind of a thing, the markets would have moved upwards to an extent, yes, but stock markets are always uh, towards the subjected to lots of fluctuations here and there. Still, it doesn't take any seasonality components. I could have imagined that this line could have slightly come down, so that, because I am seeing lots of fluctuations here, this is how it learns. It starts looking at all these fluctuations. From these fluctuations, it learns that there is some kind of a trend, there is kind of some seasonality. I need to apply those on the trend lines and then start forecasting. That is how it should be, right? Let's see when we do this for our triple exponential smoothing here. I am using an additive method. Okay, same methods. Here we have hold winter. We have this function called as holds winter. We apply on Nifty 50. For convenience sake, I'm forecasting for 24 months. Better to do it for 2 or 3 months, not more than that. Let's also look at the what the models is telling me about. I would be interested to look on what is my alpha, beta, and gamma values being taken here. Gamma is again a constant, a damping factor to reduce the noises which are appearing due to seasonality. Beta is a component which is a constant which is taking care of the noises to dampen because of the trend component. Okay, let's run this. See here. Fine. Okay, so look at this. It shows, yeah, it shows some kind of a slope. It says, I think this is somewhere around I should say around 6 months in the I should say somewhere, I think July, August, somewhere here. It says again it's going to come down to the levels of around 8,200 or so. Mm. The good part of it, what we can say here is, at least my current value, if I go and see in the Nifty 50, it falls within this 80% confidence interval. The other thing is, it is taking a seasonality component, but these are the point estimates. It will be very difficult to match to what the actual values are, because there is a high amount of a fluctuation. As I told to you, these fluctuations, it is not recognizing in neither as a trend nor as a seasonality, and it is just throwing away as a random or the reminders there. And that's the reason why it is not predicting what it should be, uh, predicting those actual values. Let's look at the alpha, beta, and gamma. The alpha, beta, and gamma, again, here the alpha increases to 0.99. It takes a very high value here. Beta, it takes I think it's 0.0001, and gamma is 0.001. So these are the damping factors. If I translate it into statistics, these are the damping factors which are being applied. One, this is for beta is being applied for the trend. This is a damping factor applied for the seasonality. Why these damping factors are coming so low? Because of that high fluctuations that it has observed there. Look at this S value. Okay, there are 12 values here. Now each of these values correspond to the seasonalities. Okay, this is for January, February, March, April. It starts applying this correction. How do we read this? It says I am going to apply 38.14% of correction on my trend component. Okay, it says I am going to apply 145 0.76% correction on the trend component, and this is negative. It means I'm going to dampen that. I'm going to dampen it and trying to bring down my trend level. So wherever fluctuations you see there in the charts, this is what it is all speaking about. If you see an increasing there, it is because of the trend and this 145% being applied there. If you see some downfalls there, this is where the negative value is working on it. Okay, now all these models also look at the Akai value, AICC values. Why are these values, how are these values picked up? These values are picked up by the method at looking at this Akai values, AICC values, Akai values. The lowest the Akai values, it says this is the best and the optimum value that I can predict. With that values, it starts taking up alpha beta, and then it starts forecasting of the point forecast for the 24 months. Okay, this is what all my data says. Now let's look at, this was an exploration which was done. If what would be my Nifty 50 look like if I take a reduced data till December 2019? Well, as good as what we had seen in the hold method, but it says that yeah, this is what the dip which is talking about. It says there will be some kind of a small dip, and then it will increase. There will be a small dip here, increase, and then it'll take up a small dip. So this is where our seasonalities are also working out. This would have been a case if coronavirus kind of a thing wouldn't have happened. Okay, this was just from an exploration per se. Now this is all what we saw is how the exponential smoothing works around. Let's see the other aspect. The other aspect in the sense, what are the other methods that I can apply? Can I look at ARIMA as one of the methods? Will it work really well the way it is simple exponential smoothing is working out? Let's see this. Let's analyze that. So all this time we were talking about exponential smoothing, and the main criteria there was it was focused on the trend and the seasonality in the data. If we compare this to our ARIMA model, it is exactly the opposite. Second is it also deals with the autocorrelation. And before we get into the autocorrelation, I'll certainly explain to you what that is all about. But if I give this Nifty 50 chart to ARIMA, what the ARIMA model will say to me is this Nifty 50 chart has trend seasonality. I don't recognize what the trend seasonalities are. If you give me trend and seasonality, I will not be able to project it. Now, ARIMA works on a simple concept of stationary. Stationary is something which doesn't change. Stationary is something which remains the same. Now, how do I do this and apply on Nifty 50? This is it. Let's look at this. This is a straight line. This shows me the trend of Nifty 50. Let's look at this 2008 scale and compare this with 2009. Can I say the the price of Nifty is increasing with a slope? Now let's look at 2009, 2010. Can I say Nifty is increasing with the same slope, right? 2010 to 2011. Can I say here, yes, Nifty is going increasing with the same slope, isn't it? Right? So what is constant? The constant here is the rate of change. The rate with which Nifty is moving is constant. Now the thing is, can I convert this into a time series? Can I take the rate of change as a time series and feed this to the ARIMA model? It can be done, right? This is where we apply a technique called as differencing. When I apply this differencing, what do I mean by that? Differencing is I will take one data point of 2008 and 2009 and take a difference of it, right? This will be my one variable. From 2009 to 2010, I'll take a difference of it. That will be my second variable. The third variable will be 2010 to 2011. I'll take a difference of it. That will be my third variable. All this variable will have a constant increase, which is constant. Something which is constant can be forecasted by ARIMA. Okay, so what is this? We have something called as differencing. We have a function called as diff in R code. I will also walk you through the R code in a few minutes from now. But I just wanted to show you this chart. This is how it looks like when we apply the differencing technique on Nifty 50. The order which was applied to it was 1. When I say 1 means I am taking only one difference for each of the time period variables and make this stationary. Also, by definition, we have that these fluctuations should revolve around the mean of 0 here. Now the interesting things comes out of it. Why are we doing this? First thing is we are forecasting for ARIMA, right? And I want the data to be stationary. But you may question this. Why? Can I say this is stationary? Where is it? Is it revolving around the mean? It's showing me such a big spike, isn't it? This is the thought might be coming into your minds. Now, the thing here is we can consider this as cyclic. Cyclic is aperiodic. When I say cycle is aperiodic means it doesn't repeat in regular intervals. It means it is random. Cycles are considered to be stationary. So with this, I can say that I have produced a chart. I have come down to a level where my data for Nifty 50 is stationary. Hold on, there is one more concept before we move on. Okay, that is of auto correlation, auto regression. I talked to you about a few minutes back about auto correlation, right? What is this? Auto correlation is nothing but if we look back to the linear equations that we have, multilinear equation and all that, and we said that there is a relationship between the independent variables and my dependent variable, which is my response. There is also another kind of a relationship. The relationship is relationship between the variables, the independent variables. And we also had learned this technique, this we also, I think we have come across the multicollinearity. So whenever we have those multicollinearities and all that, the first thing is we said is whenever we are going to develop any kinds of models and all that, we have to clear off all the multicollinearity which is there. Apply the same concept here. Auto regression also talks about the same thing. It says regression means I'm trying to find out the relationship between the variables. Why it is said as auto regression? Because it's trying to find out the relationship with its same variable. When we take the time series, when we design any kinds of a time series models, okay, we are working in univariate, we are not working on a multivariate. We are using univariate, one is single variable, but they are spread across various past observations. This is what is happening here. We are now, this is the variables are trying to regress on itself. Okay, the variables are trying to find a relationship with itself, and that is the reason why we say it as an auto regression. This is the equation that we develop to use our auto regression if you want to build a model for the forecasting. Okay, I'll not get deep into this algebraic equations because we'll be spending more time on this. My more interest is how it works for the Nifty 50 year. Now the second thing is, before we get into all that, we also need to know what the orders of the autoregressions are. Simple concept, I'll put it in simple plain English here. If I say it is an order of 1, it means I'm going to take only one variable in the past, that is t minus 1. If I say this is order 2, I'm going to take two variables into the past. But please note, every data in time series comes out with certain kind of an error. Okay, this error is denoted by an epsilon t. This forms a basic foundation for our moving average when we create models using moving average. See what the statisticians, when they were developing all these models, what they came across is, can I take errors which are in the past, taking those past observations, build up a linear equation and predict and forecast the values, right? This is the model that they came across with. This is nothing but the moving average with auto regressive errors. Now think, if I combine this with the auto regression, that is what the statisticians came across. They said the accuracy of the models is increasing if I add these errors and add these errors to my auto regression model, my accuracy increases. Isn't it interesting? That model, what we were talking about, is nothing but ARMA, ARMA. Simple as that. Auto regression plus moving average. Both models combined together as ARMA. Now, if you add the differencing technique, which we discussed few minutes back, if you add that to this model, it becomes ARIMA. Simple as that. So we have a ARMA model. The second model is MA, and the third one is ARMA, and the fourth one is ARIMA, ARIMA. We are going to work only with ARIMA. Okay, we are not going to use any other. We are going to use only the ARIMA model. Now, before we deep dive into that, there's one more concept which I want to put forth, which will be easy for you to understand going ahead. As I told you, there is a correlationship which exists. The correlationship, this we can also say it as a direct correlationship between these variables, is what we call as autocorrelation. It is given by an autocorrelation function. What I need to see is, when I develop any kind of a stationary models, the very first criteria is that the variables in interest should have their relations 0. There should not be any relationship between them. When I find my ACF going down to 0, it means I'm making it independent. At what value it becomes 0 is what my Q value is. When I develop an ARIMA model, I have three components, three parameters, sorry. It is P, D, and Q. That is the Q which I am talking about here. Now, there is another relation that we need to take care of, is the relationship between this YT and YT minus 1, having all other variables fixed or constant. This is what I'm trying. So this is kind of an indirect relationship which exists with my response variable here. This is called as, in simple terms, this is called as a PACF, partial auto correlation, partial correlationship between the variables. Okay. Now, at what value I can remove or reduce those values is what my p value will be defined here. P value, P is coming from PDQ, right? This is what the parameters which we are going to use when we are going to have the ARIMA models in place. Now, with this, let's go on to our R code and see how we can apply for our Nifty 50. Look at this. I think we discussed about this. I'll just load these libraries. I have taken a different data set just for the sake of clarity, so that they don't intermix with each other. I have created one more data set with different values. I've stored it in a different variable for analyzing the ARIMA. Here I have taken 150, 167. In my earlier Nifty, when I was analyzing, it was 157. Okay, so I think 4 or 5 months more I have taken here. Now I'm converting that into the time series object. We have seen this. I'll quickly run through this, as we have already seen this. Now, great. Now, as I said to you, ARIMA, it works only on the stationary time series. How do I see? Can I visually look at it and say, yes, this this time series is stationary? I have one method. I can do an histogram. Okay, I use a hist function on my Nifty 50 time series and I plot it. Let's look at this. Okay, here comes. Look at this. Don't you see the data is skewed here towards my right, right? And the less amount of data is here on the left. Can I say this histogram is not normally distributed? When we have such histograms which are not normally distributed, I say that data is not stationary. This is one method. This is a visualization. Now let's look at a statistical way of looking at that. Here it is. I'll also talk about the correlation. Here it is. This is the statistical way of looking at this, whether it is stationary or not. ACF stands for autocorrelation function. I apply that on the lags. Okay. I'll also talk about how I got this lags, but just for a moment, let's look at this graph. What does it say to me here? It says that the lag lines are decaying, but they are decaying at a smaller pace. When we have this kinds of an graph here, we say that the time series that we are analyzing is not stationary. If I had this time series as a stationary, then I could have seen just one or two lags here, and immediately the line would have decayed and it would have been within this statistical limits. Any lag lines, if they fall within the statistical limits, in that case, we say that the correlationship between the variables have been reduced or minimized, or we can say is as insignificant. Okay, now let's look at how we got these lags and what are these lags. Look at this. I've taken the data from December 2006. I've applied this on a window using Windows function. I've taken that lags and I have put it use a gglag plot. This is something very interesting here. Okay, this is going to form our foundation for our analysis. Look at this. It has plotted for 16 past observations. The first one, lag line. This is my very first time period in the past. This is my very last time period in the past. Now, at the very first glance, it may look like I'm not able to read this out, right? There are 16 here. So that is the reason why I'll just explain the 1 and the 16, which will make you very clear. Do you see a small line here? It's a diagonal line. It's a thin line, a diagonal line here. Now, look at this. The data points are spread across these lines. They are not on these lines. What it is telling me is the relationships are weak. If I look at the lag 16, it says the relationship between the variables are weak. Hence, it is away from the diagonal line. Look at this lag 1. Look at this. All the data points which I have are distributed on this diagonal line. The diagonal line is not visible, but it is being overshadowed by all these data points, right? So this is where, what can I inference from this? It says, but the relationship is very, very strong. Now let's look at all this. As and when I move into the past, I move into the past, I see that the relationships are decreasing. So I can say that for 6 to 7 lags, the relationships are very, very strong. Okay, this is where I have to apply my ACF and PACF to reduce the relationship or eliminate. In practicality, we will not be able to eliminate, but we can reduce. Okay, with this, we move on to do an statistical test. This is a statistical test that we apply for our um, time series. Now, the null hypothesis here is the time series is not stationary. The alternative hypothesis is the time series is stationary. I apply ADF, augmented Dickey-Fuller test. Okay. We also have KPSS, but we usually work on the ADF here. What it says is the value, p-value is 0.3334. With this, I can say that I cannot reject my null hypothesis, which means that the time series is is non-stationary, so I need to make it stationary. How do I do it? I use a order difference of 1. So I use the difference diff function on the Nifty. I guess the first order differencing here. Okay, this is what it is. I think I even talked to you about this. So we will quickly move across to the ADF test. Okay, here it is. Now I need to again see whether my data is stationary or not. Statistically, this was visually. Now I need to see it statistically. Let's run this. This is what it is, 0.01, which is less than my p-value of 0.05. So I can easily say here is my time series is now stationary. Let's apply the ACF and the PACF to see whether what is the correlationship. Okay, for a d is equal to 1 value. Look at this ACF values, all the lag lines, they fall within the statistical limits. I can safely say that and confirm that yes, the relationship do not exist between the variables. Look at the partial relationship between the correlations. They fall within this statistical limits, and I can easily say yes, they are independent of each other, right? Now we apply a two split method. We can also apply a three split method. What are these methods? Two split method is I'm referring to the train and the test. Three split method is train, validation, and testing. So that is a different validation technique. I'm not getting into it. I'm using the most simplest one, two split method, dividing my data into train and test. Okay, we have seen this in our Nifty 50 training and test. I have this data into my training data set and my test data set. Now I run the auto.arima, okay, on the training data set. The concept here is I build a model on my training data set and then I compare it with my test data set. With that, I start looking at what are my accuracy levels. Okay, so with that, yes, it says the ARIMA model with 010200 will be a good fit for the Nifty 50. What is the 010200? This component, okay, the first one which I'm talking about is for the trend. You need to apply PDQ values. These are the best values you can select for the trend component, and these values T200 PDQ values of 200, this will be the best field values for the seasonality. How does it come out with? It looks at the Akai value, AICC value 2193, and it says yes, this is the most optimum value that I can come out with and give you an the model with which you need to proceed and apply on a Nifty 50. Okay, now there are two things here. I applied auto arima. There is a manual way of also processing that. Now why you may say, when we have auto, why should we go for the manual one? Okay, that's the question that may come in into your mind. So see here in manual arima model will give me some kind of a flexibility. I can take the PDQ values uh, and fine tune it. This is where I'm going to fine tune my models to work on the Nifty 50. Okay, just before that, I get into that concept. First let me look at the accuracy levels, what my accuracy levels are telling me about. So I forecast that on my training data set. I store that in one of the variables. Then I forecast what is my the forecast. I plot on my forecasted values. Okay. Then I take this test value and bind it with my training data set. Why am I doing this? I wanted to see uh, how actuals work with the forecasted values. Okay, how does that plot look like? So this is it. This data we had taken till, I think, yeah, we forecasted here. See, we forecasted from 2019, that is July 2019, right? This is what it is giving me here. Now, the interesting part is why I did it from 2019 is I wanted to see whether the March 2020, is it predicting that March 2020? But obvious, I just wanted to explore that. It can't predict that kind of an downfalls, but it can just give you somewhere 80-95% confidence that well it can tell you what can be the fall. But the again, the actual values will not be compared. Actual values cannot be compared with the forecasted values. But the good part is it is just taking up those trends, it taking up those seasonalities. I can see a downfall here, and that's the downfall in even in the March, right? So it is predicting that. It's predicting some kind of a downfall. Now let's look like how the actuals are looking when I compare with my forecasted values. So here it is, not very close, right? The moment I see this, it's not very close. Now, how do I fine tune this? This is where our data science concepts and my data analyst data techniques will come into picture. What I need to do here is I have to take an ARIMA model, start picking up the PDQ values. Second, I need to take training data sets, multiple training data sets, multiple testing data sets, start measuring their accuracies, start comparing their accuracies, start averaging those accuracies, and come out with the most optimum value. This is time consuming. It really takes a lot of efforts. And second thing is, sorry, and the second thing is you have to parse your code with with certain kinds of loops involved there. You have to loop in with different values. You have to take permutations of PDQ values, run a loop there, take lots of various data sets, apply on it, and then come out with the most optimum value. Then you may get something a very closer value to what you have estimated. The forecasted will be very closer. Still, I don't claim that the values will match. There is no such model. Maybe we have to go further deep dive and see there. But predicting this forecasting, coming out with a forecasting model which can be closely related to is possible, but closely matching with its one-to-one matching may be very difficult task. Okay, with that, let's look what the accuracy of our model is now talking about. I'll also explain this accuracy, what they mean. Let's look at this MAPE values. Okay, here I have manually calculated the RMSE, okay, root mean square values, and I have also taken up the accuracy function which gives me all the values. It gives me the RMSE, MAPE, MPE, then MASE, RMSE, and all that. Okay, let's look at the interest of for us would be MAPE, MAPE, and RMSE. I'll explain about this. How do we interpret? MAPE is, it is always in the percentage. Here it is 12.06. What it says is it is 12% away from the actuals. Okay, that is why I was saying that it needs to be fine-tuned. You can't put in your hard-earned money there and look at saying that the it is okay if my value is 12% away. 12% is huge in the stock markets. 10, 12, 4%, 5% is also huge. Maybe 1% here and there is okay. Maybe 1.5, 2% is also okay. If something greater than 4%, 5% is huge. Okay, because we are dealing with money. Having said all this, there is one more criteria which we also need to look at to say that yes, my data is stationary. As I said to you, there is a component also which is called as the residuals, randoms. We also need to have those checks in place. Are they really independent? If I do not have those independence, my forecast values will be hayward here and there, and the model may not work. And that is the reason why we also need to see what my residuals are talking to me about. So we have a method, a function called as check residuals. This you can find it in the forecast 8.0 package. Let's run this and see what the outputs are. Yes, good, fantastic. It looks stationary, it's revolving around the means. Second, look at this ACF. It says yes, the residuals of the ACFs are independent of each other. Then it says yes, this is what I was talking to you about. It says that the residuals are more or less normally distributed. When we have more or less normally distributed, it means the data is stationary. So here I can confirm my residuals are stationary. Okay. Now, this is it. This is all the manual way, which this was a part of the exploration which I did. How it works, I take the same values of PDQ and apply it. I also try to do lots of some, fine tuning activities here, and try to see how my actual values correlate with my forecasted values. So I'll just quickly run through this. Okay, because this takes lots of efforts. There is a lot of fine tuning activities that we need to do here. This the next one is the box test that we applied. Box test is, this is just another way I wanted to show this, how we can apply the box test on the residuals. Here we, the null hypothesis is the residuals are independent, and the residuals are the alternate hypothesis is residuals are not independent. This is just to showcase how things run. Once you get the R code, you can play with this. And I just wanted to see what the accuracy levels are for my ARIMA manual way of working on that. And this is yeah. Now the other part is, now if say my data has lots of variance. Okay, fortunately I don't see a lot of variance because we have taken a monthly data. Okay. If we would have taken a daily data of Nifty 50, I could have seen that variance, but I just wanted to explore and see. Okay, so what I did here is I have taken the difference of it, then I applied a log. First I took a logarithmic log of the time series. Now, why am I taking the log of time series is, this is what we call as a transformation of the data. When I transform the data, I am trying to reduce the variance. Transformation, we have several methods. One is log, you can use square root, squares, you can use, there are the other methods there. I'm just trying to recollect that. But yes, they are log, you can use cube roots, square roots and all that. Okay. So I used log on it. Then I started putting a one order of difference on it so that I can make it stationary. Is it stationary or not? The plot will tell me about it. This is a visual representation. This is as good as what we saw it earlier. Yes, it says yes, it is stationary. I use an ADF test, ACF test, and the PACF test to see whether it is stationary, to see whether the relationship between the variables are independent of each other or not. I run on it. I see yes, all the lines, lag lines, lie between the significance levels, and I can easily confirm that they are independent of each other. Okay, and what I do here is I run a manual ARIMA on the log transform data. This is required if you have variance in your data. Okay, this is being done here just in case you require this code to work on with the daily data. Daily data will have lots of variance. Okay, this is, we again checked on the check residuals for the method that we came across. Okay, now with this thought, let's move on to the slides here. I wanted to put up a thought before you guys. We have seen there the simple exponential smoothing, the double exponential smoothing, and the triple exponential smoothing, right? So, and the ARIMA here, see the accuracy levels. Okay, the accuracy levels are, you may say, uh, the Holtz method works fantastically well here because the MAPI value is very less, 5.2, when I compared it to ARIMA and all that. Now it also depends on the data that you're taking. Second, it also depends on the PDQ values that you have taken for the ARIMA. It also depends on the alpha, beta, gamma values that you have taken for your Holtz, the Holtz winter model. That is where we need to do more of fine tuning activities, and then try to come up with the best values which will be for the MAPE and the RMSE. So this is the question which I like to put forth before all of you here, is which is the best method that I can work with. The answer, my answer to this will be, friends, this is a stock market where we have to fine tune. As I said, we have to come out with the PDQs values, do lots of other algorithms, work on it, and then come out with the more accuracy levels. So what we have done here, all this, the exploration that we have done here is, it is just a tip of an iceberg. Methods, as I said, can be fine tuned. And as I also said to you, we have to work on those ARIMA models where we have to fine tune them to find the best PDQ values there. The question is, are there any other methods that we can work out with? Yes, we can. We can explore that even in the deep learning. We can explore this with random walk methods. Random walks method, in my view, may work much better. I have not explored that, but we can explore it. Why? The reason is random walk method doesn't work on the times, that it doesn't work on the concept that it needs a time series which is stationary. It says give me any non-stationary data, I can even work on it. Most of the financial data that we have, uh, the random walk is the method that is being works better on the financial data. Okay, so we can also explore that. So since the financial markets are very unpredictable and they are bound to have several fluctuations, the fluctuations that we have seen, like the fluctuations which we have seen during the surgical strikes, the Brexit vote, the coronavirus March 20 that we have seen, that can bring in huge fluctuations, which will be really, really very difficult to predict from any kinds of forecasting methods. So I leave you with that thought. There is a lot to explore further, and hope you will continue this journey for exploring many other methods or fine tuning the same methods that we have come across today. Thank you very much. With this, I end my session. Open for any questions.
Can we use time series cross validation to strengthen the mode?
Yes. You can use that cross validation. So that is where I was talking about cross validation, in the sense, I even spoke about the three split method, right? The three split method that I was talking to you about was the training, the test validation, the validation data set, and the test data set. Also, what you can do is you can also use a tenfold validation or an n-fold validation. You can do that, do lots of churning in it, and then come out with an RMSE and the MAPE value which is the lowest. That also may work out well.
Okay. So the next question is this an additive decomposition or multiplicative? And also,
Thi-
when do we use additive and when do we use multiplicative?
okay, so this is an additive method that we have used. Okay, the second is, when do we use additive, when do we use multiplicative? um, when the variance is constant across any time, across equal time periods, we use additive method. If the variance keeps increasing with certain rate at equal intervals of time, that is the time we use multiplicative method.
So can you please help reiterate if the data needs to be split as training and testing?
Yeah, the data has to be split into training and testing. There, that is a two split method. We can also work out with a three split method. What I was telling is, take a training data set, take the validation data set, and the testing data set. That is called as a three split method.
Okay.
You can also work out with that. Yeah, and one more point here is, you have to have a huge data. Now, uh, you observe that why I took data from 2008. I took it purposely. The reason is, from 2008 to 2009, that was the time there was a big fall in the market, the prime crisis. So in my model should also be able to learn those kinds of big falls. Now you may question, fine, then it was a big fall. Why did not it learn and then try to project it for March 2020? Now look at this, 2008 and 2020. It's almost 12 years into the past. So when we apply all this simple those exponential smoothing methods and that, it starts averaging that, and it starts giving the highest value to the most recent past, and it starts giving the low weightage to the time period which was into the somewhere around 10-12 years back. The weightage is very low there. That is the reason why it was not able to learn. If there was such a kind of a fall, say around say 4 or 5 months back, it could have learned that and it could have projected very closer to what we are seeing currently.
So, and the next question is, can you explain about the fine-tuning methodologies that we can implement on the variance found in the results of training and test data fetched?
Let's take this way. I'll get into the R code. I think that will be easier. Now, what you need to do here is this. These are my PDQ values for the trend component. These are my PDQ values for my seasonal component. What I will do here is I will create a function. I will write the PDQ values. I will loop it. When I say loop it, I will loop it for different values of P, D, and Q. What do I mean by that is I'll take 0, 1, 0. This is my one data point, data parameters. Then the second one will be 0, 1, 1. Then I'll take 1, 0, 0. Then I'll take 1, 1, 1. I'll take 2, 1, 0, 2, 0, 0, 2, 1, 0. I'll keep doing this. I'll run it in a loop. With that, I'll also compare it with the seasonal component. This is one way. The second way is look at the data sets, the training and the test data set. What I will do here, I will create a different sets of data sets. Now, what I mean to say here is, this is my one data set, training data set. Next, I will do is I'll take values of 4 here. Okay, and my training data set now will testing data set will start from 5. This is one data set. Then I will increase, I'll go back into the past, say this is 2018. I'll start from here, 2018, and I'll run this. I'll get an RMSE values. Third, I'll take one more data set, say from 2017. I'll explain you this or even on the graph. 17. Okay, I'll take this as my third data set. I'll come out with an RMSE value. This is what I need, what we have to do by taking different data sets and coming out with my RMSE values. Look at this. Why am I doing? I'll just show this on the graph. So see what I'll do. This from 2000, say this is 2009 to 2012. I'll take this as one data set, training and test. Second, from 2012 to 2000, say this is 16. I'll take one more data set. From 2016, I'll take from here somewhere, I think 2018, I'll take one more data set. What am I trying to do here is, I'm telling the model, take this recent, take this recent downfalls, learn this recent downfalls, and build a model for me. Now what is happening? I took an entire data set from here to this particular point. It was not able to read this. It was not able to learn this, because all the exponential models and all that we have learned, it starts giving the maximum weightage to my recent past, not which has happened 12 years back. So by dividing my test data sets in this way, it starts learning this falls, this fall, this fall, this fall. It will also learn these uptrends, this trend, this uptrend, this uptrend. So if I have those kinds of data sets with me and build up a model, I can come out with a better accuracy. So that is why I said this is a bit of time consuming. It really needs a good amount of effort, but yes, it can be done.
So moving on to the next question, is auto ARIMA more accurate compared to the ARIMA function?
Now let me explain this concept. Auto Arima. Auto Arima doesn't understand the business objective. Auto Arima only understands what is the best value I should give it from R code per se. Okay. Or again, I repeat, Auto Arima doesn't understand the business objective. It just understands the statistical objective. That's it. What is the statistical objective? Give me the most optimized value. Now, coming down to Arima, this is where you have the control in your hands. You being as a data analyst, a data scientist, you know what the business objective is. So here, if I compare to my Nifty 50, my business objective here is I have to get it more accurate because of this downfalls. And that is why I explained you here. I know from the business objective that it is not taking those falls which had happened from 2008 to 2009. It was not taking those falls from 2015 to 2016. Isn't it my business objective to learn even this downfalls, right? Because my business objective is to come out with the best accurate model that can also see the fall which has happened from March 2020. My auto Arima doesn't understand. My auto Arima doesn't understand, I have to take this fall, though it is 12 years back. It just understands I have to take this. I have to give more weightage to this. I have to give less weightage to this. I need to give lesser weightage to all this. So where does the business objective come in? Dividing the data sets into smaller data sets so that you pick up all the uptrends and the downtrends. So there is no direct answer to your question whether auto Arima is best or the manual Arima is best. Manual Arima works better because it is good. I can say this is my view. Manual Arima because you have the controls in your hands from the business objective per se. So you need to fine tune it.
So it's like,
Yeah.
so when you do this in-depth analysis, who will be the stakeholder? So that is the first part of the question, and the conclusion that is generated from this analysis. So is it more generic or more specific? Like, will it be good or to buy or sell shares with this particular depth?
No. Okay. That is the reason why I came up with a disclaimer there. Okay. The disclaimer says do not try to buy and sell this. This is not an offer being made. If we can, show this slide again. Let me
So,
show this.
or that is something which is any which is present in the deck. So I think we can move on to the next question also.
Yeah. So just to answer that, so why this is being presented here? It is the presented here to give you an idea of the methods that we have learned in the class, how that can be applied on this. Whether it works best or not is a call that you need to take here, and this is being given to you so that you can fine tune it. Okay, because this is where we can't give it a ready made, and there are several analysis. If I go back, there are technical analysis also. There are so many methods there. People have devised strategies there, lots and lots of strategies. People have spent five years devising those strategies, and that is why I said, it's very difficult to predict, but it is not impossible. But the efforts needs to be made in that direction. That is where people have developed a very complicated, very difficult. They have spent in five years to build up a strategy which is working for them. So to answer your question, this will be just a start, a tip of an iceberg, as I said to you. This can be modified, learned, and who will be the stakeholder? It's just for the educational purpose. This has nothing to do with any kinds of investing or taking a calls in the market. Yeah.
Okay,
Thank you.
that I hope that question is answered. So the next question. So how can we April 20 rise. Is there any way to keep updating it, let's say weekly, to get forecasted?
Okay, good. Here comes again that time series. Can we do it weekly? The problem with the weekly, you can do it. You have to do some kinds of modifications. Now, why am I saying that? Is when it comes to the weekly data, you also need to take certain holidays into consideration. Okay, the weeks may differ. When I say for the month of this is April, so month of April I may have 4 weeks. When I go down to uh, April May, I may have 5 weeks. So the time series, when we apply time series concepts, the week periods should be constant. I can't have 4 time periods in 1 month. I can have 5 time periods in the 1 month. Okay, so you need to do some kind of a fine tuning. What fine tuning will you do there? You have to label that. You have to come out with some kinds of a labelings. So you have to give completely from 1 to 52 weeks, irrespective of the months. But then in your internal coding, what you need to do, take that up and give some 1 to 4. You've develop some kind of a core code where you will say 1 to 5 weeks will be my month of January. Then next, if you come down to February, you may find I think around 3 to 4 weeks. So you have to, the next 4 weeks which are going to come in, say 1 2 3 4, then comes in 5 6 7 7. So 5 6 7 I'm going to label for February. That fine tuning you need to do and then start applying it as a weekly basis.
So the next question, that we have received is how to train the same model with different set of training data.
Yeah, so exactly the way we did it here. Okay, so I think I showed it on the R code. Okay, so this is that window. Okay, how do you take different data sets? So as I told you here, this is for 2017. I'll change this to 2016. Okay, this will be my one data set. My second data set, I'll change it. I can change both month and the year. I'll take it to 2015. I'll change this my test data set from 2015. This will be my second data set. What will be my third data set? I'll take it from 2018. I'll take it one more from 2000, my test data set from 2018. This will be my third data set. So I need to keep taking some data sets and then start finding out the RMSE values. So even I am in this exploration process. I may do it in the near future and see, because this is a very interesting subject to make it happen. Okay, and look at the Nifty 50 charts. Before we wind up, you have to look at this disclaimer, because this is not a mechanism to go and trade in the market. Okay, so this is only for the educational purpose, how we can implement, whether it works, if how we can fine tune it. This is from the learning per se. Okay, fine. Sorry, Saurabh.
No problem.
Please
No
go ahead.
problem. So there is actually one question, that we just received. So
Yeah.
does the ARIMA have a real-time business application, or is it more of an academic exercise?
No. ARIMA has a business application. It has a business application. Otherwise, there wouldn't have been these models developed. They have their applications.
This brings us to the end of this tutorial on time series in stock market. Now, before you guys sign off, I'd like to inform that we have launched a completely free platform called as Great Learning Academy, where you have access to free courses such as AI, cloud, and digital marketing. So thank you very much for attending the session and have a great learning ahead.